Okay, let's unpack this. Today, we are doing a deep dive into Clean Harbors Inc., ticker CLH. This company is really, you could say, the backbone of modern industrial compliance. They're North America's premier provider of environmental and industrial services. They handle the kind of waste streams that, well, frankly, define the difference between a company that's operating safely and one facing, potentially catastrophic environmental liability. So, our mission today to really analyze a business that analysts often talk about as having an irreplaceable asset network. They're sitting right at the intersection of some really powerful, like non-negotiable trends. Think tightening environmental rules, the big corporate focus on ESG, and also the shifts we're seeing with manufacturing coming back onshore, reshoring. And the big question, the central question we're wrestling with is this. Clean Harbors, well, its stock trades at a pretty high valuation. That price already seems to bake in some aggressive growth expectations. So can the company's real structural advantages, particularly their dominance in things like hazardous waste incineration, and this emerging opportunity around forever chemicals, can that allow them to not just meet but actually beat those expectations? Can they deliver truly exceptional long-term returns from here?
That framing is, I think, spot on, because understanding clean harbors really means understanding their unique spot in the economy. This isn't just some commodity business. It started way back in 1980, just a small tank cleaning outfit. But it's grown both organically and through some really strategic, pretty large acquisitions to become the absolute largest hazardous waste disposal company in North America. They specialize in the really complex stuff, the compliance-driven waste streams that honestly most competitors are either too small for or they just don't have the permits to handle. And their customer base shows us, right? It's a huge network, covers a majority of the Fortune 500 key government agencies, plus thousands and thousands of smaller but still highly regulated companies. It's also important, I think, to remember the geography here for this deep dive. About 91% of their revenue, this was in 2024, came straight from the U.S. market. So they have a really deep pulse on what's happening with regulations domestically. So how we'll break this down? First, we'll look at the company's structure. It's quite unique, a strategic mix of two very different business segments.
Then we'll really dig into that competitive moat. It's formidable, built on those assets. We'll definitely spend a good chunk of time on the growth catalysts, huge ones, especially PFAS, which looks like a multi-decade kind of opportunity. And then, we'll wrap up by scrutinizing their recent financials, their capital strategy, and importantly, benchmark their valuation against their peers who are close but, well, distinct.
Okay, let's start right there. With that structure, it really is a tale of two segments, strategically linked. And we have to begin with the core engine, right? The environmental services segment, or ES, this is the big one, the undisputed leader. Projected to bring in about, $5.0 billion in 2024 revenue. So largest, most resilient, and most profitable part of the company.
Yeah, the ES segment is really where that core strategic value lies. The business model is basically end-to-end management. Hazardous materials, non-hazardous materials. We're talking collection, transport, highly specialized treatment, and then the absolute cornerstone, final permanent disposal. And that final disposal, it relies completely on their own proprietary infrastructure, stuff that's heavily regulated by the federal government. This includes their RCRA-permitted incinerators, those secure landfills, and a pretty vast network of specialized wastewater treatment facilities. For anyone listening who might not know, RCRA, that's the Resource Conservation and Recovery Act. It is the single most important federal law for hazardous waste in the U.S. Operating under those permits, it's a huge multi-decade commitment. Very few companies can actually manage it.
And the performance numbers really underscore how powerful this core engine is right now. Fiscal year 2024 ES revenue grew, 11%? Robust. But what's maybe even more telling is the margin profile. Their adjusted EBITDA margin expanded to a really strong 25.3%. That margin expansion, that was almost 100 basis points, right? A full percentage point. That shows real operational leverage.
Exactly. And that margin, that leverage, it comes directly from their dominant market position. And specifically, how much they're using those critical disposal assets. If you look at their incinerator network, which you absolutely need for destroying the most difficult, complex, toxic waste, it was running at an incredible 94% utilization rate. That was back in Q4 2024. When capacity for that kind of specialized disposal is that tight, the supplier, Clean Harbors, in this case, they can command and enforce strong pricing. Simple supply and demand, really. Demand is structurally just outpacing supply.
And their strategy seems to be about feeling that high-margin disposal network more volume, right? Through strategic M&A, specifically building up their industrial and field services, things like specialized cleaning, facility maintenance, and those high-stakes emergency response jobs we saw with the Hydrochem PSC deal back in 2021. And then more recently, 2024, that $400 million HEPACO acquisition. HEPACO specializes in emergency spill response. These deals just drastically increase their scale, their geographic reach, especially for that high-margin, event-driven kind of cleanup work.
Precisely. It's about integration, these acquisitions, not just getting bigger. Okay, now let's shift gears. Let's talk about the second segment, the more cyclical side of the business. Safety, Clean Sustainability Solutions. It's KSS. This segment, it's the North American leader in the sort of circular economy for used oil, generated around $900 million in 2024. SKSS is the biggest collector and re-refiner of used oil. They recycle that waste oil back into high-quality base oil and lubricants.
Okay, so if ES is the stable engine fueled by regulations, SKSS is more of a commodity play. Its profitability hinges entirely on what they call the re-refinery spread. Is that right?
That's it, exactly. The spread is the core economic calculation. It's the price they have to pay or sometimes charge to collect used oil from thousands of garages, industrial clients, versus the market price they get for the finished base oil products they make. And that's the segment's vulnerability. The price of base oil is just fundamentally tied to global crude oil prices, broader commodity market swings. It's volatile. And we saw the direct hit from this volatility in the recent numbers. Q2 2025, SKSS revenue dropped sharply, down 14% year over year. Now, this wasn't like an operational issue. It was purely a consequence of that continued softness in base oil pricing, driven by, external global commodity dynamics, stuff they don't control.
Right. So given that volatility, management obviously isn't just sitting back. They've taken some pretty aggressive steps to try and stabilize the profitability there, including, I think, idling one re-refinery to manage costs, and maybe more importantly, implementing a strategic shift to a charge for oil model, CFO.
Yes, the CFO model. That's a deliberate move. They're trying to transition SKSS away from just relying on the commodity value of the oil itself. Instead, they charge a predictable fee for the essential service collecting the oil. It helps decouple their revenue, somewhat, from that volatile base oil price. Smart hedge, really.
Okay, now here's where, for me, it gets really interesting, where the whole company becomes structurally smarter than just the sum of its parts. SKSS, right, despite being cyclical, operates this massive network, serves over 100,000 customers. And a lot of these are the smaller guys, small to medium-sized waste generators, auto shops, small machine tooling places, local manufacturers.
Exactly. And that huge customer base, it isn't just revenue for collecting oil. It is a proprietary, very low-cost customer touchpoint. It generates invaluable leads. Think about like a small machine shop. They need SKSS to come pick up their used coolant and oil regularly. Routine stuff. But while the SKSS rep is there, they notice, hey, the shop also has several drums of spent solvent, maybe some contaminated sludge over in the corner. That's hazardous waste. That needs specialized RCRA disposal.
Okay. So the SKSS visit becomes a sales opportunity for the other side of the house.
Precisely. It transforms the commodity-exposed SKSS business into this incredibly powerful strategic lead generation engine. Feeds right into the high-margin environmental services segment. They use that existing relationship, that trust, to seamlessly cross-sell the higher-value ES services. Containerized waste disposal, field services, maybe even regulatory consulting. And in doing so, they often push out smaller, local competitors who just can't offer that integrated service. It's the core strategic genius, really, funneling commodity relationships into resilient, high-margin ES revenue.
That seamless link is, a perfect transition. Let's get into Section 2. Detailing that irreplaceable asset network, the thing that creates this massive competitive moat, the foundation of Clean Harbor's whole business, their pricing power. It's built on assets and regulatory approvals that are just, well, analysts say exceptionally difficult to replicate. I think that's probably fair.
We really have to emphasize the scale of the challenge for anyone thinking about competing here. The company is protected by what we could call the permitting wall. And this wall, it's built on two huge, almost insurmountable hurdles. There's the financial hurdle, obviously, and then there's the regulatory hurdle.
Let's dig into that regulatory challenge a bit more. It's not just the money, though the capital needed is enormous. Building a brand new, highly regulated facility like one of those hazardous waste incinerators, it takes multi-year permitting processes. You're talking local, state, and federal levels. They mentioned the new Kimball, Nebraska incinerator as an example, right? $210 million in capital. But crucially, it took 4 years just to get the green light for commercial operation. 4 years.
And that timeline, 4 years, it doesn't even fully capture the other barrier, the non-financial one, which is public opposition, the classic NIMBY phenomenon, not in my backyard. Hazardous waste facilities are maybe the single most resisted type of industrial development out there. Finding a community today that's willing to accept a new RCRA-permitted incinerator or even a secure landfill, is practically impossible, just due to the political heat and public resistance. And this scarcity, which is basically enforced by community pushback and decades of tightening regulations, it creates a powerful economic advantage. It protects the incumbents, like Clean Harbors, and allows for consistent, rational pricing across the market. There just isn't enough capacity.
Yeah, it makes you realize the company's true value isn't just the physical plants. The real intrinsic value is locked up in that portfolio of regulatory approvals. Over 600 operating permits for various facilities across North America. The source material suggests this permit portfolio is arguably their most valuable asset. And its true value isn't fully captured on the balance sheet. It's like this unquantifiable regulatory goodwill, but it's absolutely critical to their dominance long term.
And then, shifting to the customer side, that moat gets even deeper because of incredibly high customer switching costs. When you're generating hazardous waste, compliance isn't optional. The law, specifically RCRA, imposes what's called cradle-to-grave liability. What that means is if a customer tries to save a buck, goes with a cheap, maybe unreliable provider, and that provider messes up, mishandles the waste, the generator, the customer who produced the waste, remains legally responsible forever. For the cleanup, any fines, everything.
Wow, okay, so if the potential liability is that catastrophic, we're talking massive fines, long-term lawsuits, huge reputational damage, and just not going to shop around for the lowest bidder, are you? Customers have to prioritize absolute reliability. They need a provider with a spotless regulatory track record, deep technical expertise.
Exactly. And that deep-seated hesitancy to switch from a trusted, established provider like Clean Harbors, it basically ensures that the ES segment enjoys really sticky recurring revenue and very long-term relationships. And the final piece reinforcing that moat is just the advantage that comes from earlier scale and integration. Clean Harbors' extensive logistics network, all the trucks, service centers, disposal sites, it gives them a massive cost and efficiency edge over smaller regional players. And this is why that M&A strategy, buying companies like Hydro Campiesi and Hepaco, is so clever. It wasn't just about adding customers to a list. It was about vertical integration. When Clean Harbors does an industrial cleaning job now or responds to an emergency spill using those acquired capabilities, they capture that newly generated waste stream themselves. Instead of sending it off to some third-party disposal site where they lose the margin and control it, gets funneled directly into their own high-value, often capacity-constrained core disposal network.
Right, the one-stop shop approach.
Exactly. It controls the whole value chain. It maximizes the economic value they can get from every single client relationship.
Controlling that value chain is key, especially because the market they're in is being pushed forward by these huge structural forces. So let's move into Section 3, the secular tailwinds and those really multi-decade growth opportunities.
Okay, first, the primary driver, the non-negotiable one, the regulatory environment. It basically functions under what you could call the immutable ratchet effect. Demand for Clean Harbors' core services is fundamentally non-discretionary. It's driven by mandatory compliance, full stop. And if you look at regulatory history, environmental standards, they rarely, if ever, get less stringent. The ratchet only turns one way, tighter. So stricter enforcement, evolving science, identifying new risks, new rules being written. All of this continuously creates fresh, non-optional compliance needs, which immediately generates new revenue streams for the companies like Clean Harbors that hold the right permits and have a technology to handle the waste. The macro environment backs this up too. Hazardous waste management in North America as a whole is projected to grow pretty consistently, something like a 5% to 7% CGR for the foreseeable future. It's a stable, growing backdrop.
Okay, but the single most compelling long-term opportunity, the potential game changer everyone talks about, is this emerging challenge from PFAS, the forever chemicals catalyst. This really feels like the definition of a nascent market. Multi-billion-dollar remediation needed, and it's just starting to ramp up globally.
Yeah, this is a major structural differentiator for Clean Harbors. They saw this environmental train wreck coming early, and they proactively developed what they call a total PFAS solution. And this isn't just one service. It's an integrated end-to-end management system. It covers sampling, analysis, specialized water filtration, remediation techniques, and this is the absolute key part, the final permanent destruction of these incredibly complex chemical compounds.
And when you talk about liability, like that cradle-to-grave concept, PFAS is maybe the ultimate example, right? These things just don't break down naturally, so customers need absolute certainty that they're truly gone, eliminated. And this is where Clean Harbors seems to have secured a really key competitive advantage, scientific validation. You can't just say you can destroy PFAS effectively. You have to prove it.
That's absolutely right. Credibility here is built entirely on science. There was a recent, very rigorous EPA study. It demonstrated that Clean Harbor's specialized high-temperature incinerators can achieve a destruction efficiency of up to 99.99999% for key PFAS compounds. That's 6 nines destruction. That level is critical because it meets the most stringent new testing standards, the liability standards that regulatory bodies are demanding. Having that third-party, government-backed validation, it positions them as the trusted sort of go-to provider. When a major city or an airport or a big industrial company needs to eliminate potentially millions of dollars in long-term PFAS liability, who is it going to choose? They'll choose the provider with the scientifically proven, fully permitted technology.
And crucially, this isn't just some future dream. It's happening now. The opportunity is already contributing. The company generated, between $80 million and $100 million in PFAS-related revenue just in 2024. And that number looks set for pretty substantial long-term growth, especially as federal guidelines tighten up, particularly the expected designation of more types of PFAS as official hazardous substances. That will trigger mandatory cleanup projects all over the place. Military bases, industrial sites, municipal water systems nationwide.
Yeah, absolutely. And beyond that regulatory push, there are underlying industrial and economic trends that are also adding fuel to the fire. We're seeing these powerful, favorable trends like the reshoring of manufacturing, bringing supply chains back domestically, which means more complex industrial waste is being generated right here in the U.S. and Canada, not overseas. And this gets amplified by major government investments. Think about all the funding from the Infrastructure Investment and Jobs Act, or the huge subsidies from the GPS and Science Act for building semiconductor plants domestically. New semiconductor fabs, for instance, they generate really unique, highly regulated chemical waste streams. Only specialized providers like Clean Harbors can handle that stuff properly. So more domestic, high-tech industrial activity that directly expands the most lucrative slice of their addressable market.
And that expansion feeds directly into the last big, very visible growth driver we need to talk about. The ramp up of that new Kimball incinerator in Nebraska. We already talked about how scarce incineration capacity is. Kimball is the tangible solution to address that scarcity, and it gives investors a really clear, quantifiable source of extra earnings coming online.
Yeah, the North American hazardous waste incineration market has been capacity constrained for years, which, as we said, is what drives their pricing power. The Kimball facility added a crucial 70,000 tons per year of new capacity, desperately needed capacity. It officially launched commercially late in 2024, and management reported that in just the second quarter of 2025, that facility processed 10,000 tons. They expect the full ramp-up, getting to maximum capacity, to happen steadily over the next, say, 12 to 18 months. So this gives investors extremely high confidence. It's a clear, visible source of incremental revenue and EBITDA growth, and it doesn't rely on predicting future regulations or creating new markets. It's just basically opening a valve to meet existing unmet demand.
Okay, so let's move into section 4 then. Let's look at the financials. How are these structural strengths actually translating to the balance sheet and the P&L? The overall health, looking back a few years, has been stellar. Really impressive growth, like a 17% compound annual growth rate, CAGR, in revenue, and an 18% CAGR in adjusted EBITDA. That was from 2020 through 2024. They hit record numbers in 2024, right? $5.89 billion in revenue, $1.12 billion in adjusted EBITDA.
Absolutely strong track record. However, the more recent trends, looking into 2025, they perfectly highlight that segment divergence we talked about earlier. In Q2 2025, total company revenue was basically flat year over year, came in at $1.55 billion. Yeah. What happened was the robust regulated ES segment grew 3%, but that growth was entirely offset, basically swallowed up by the sharp cyclical decline in SKSS, which was down 14%.
Right, and this is a critical point, I think, for understanding the earnings quality. Despite that flat top-line revenue, the consolidated adjusted EBITDA margin actually expanded. It went up by 60 basis points. That's 0.6 percentage points, hitting 21.7% for the quarter.
Exactly. That margin expansion, even with flat revenue, it's really a testament to the resilience of the overall business model. It proves that even when the cyclical SKSS part struggles because of outside commodity factors, the overall quality of earnings actually improves. Why? Because the mix shifts favorably towards that structurally higher margin core ES segment. And you saw management's confidence in this when they reaffirmed their full year 2025 guidance. They're still guiding to $1.16 billion to $1.2 billion in adjusted EBITDA. That reflects real confidence in the core business's underlying strength.
Okay, so let's talk about how they use that financial strength, how they allocate capital. Clean Harbors is clearly a strong generator of free cash flow, projecting, $430 to $490 million in adjusted free cash flow for 2025. And their priorities seem crystal clear. This is a growth company, right? Not an income play. which explains why there's no regular dividend.
Yeah, their capital allocation follows a pretty disciplined hierarchy. Priority one is definitely high-return organic projects. Things like the Kimball incinerator expansion. That's what drives their significant CapEx budget projected at $370 to $400 million for 2025. Priority two is strategic M&A that fits, that's synergistic, like the Nepico deal we discussed. And only third on the list is opportunistic share repurchases, though they did buy back $67 million in stock during Q2 2025, which does signal, management's belief that the stock is probably undervalued.
And they're also being proactive about managing the balance sheet, right? Keeping financial flexibility. I saw in September 2025, they successfully refinanced about $745 million in new senior notes, pushing the maturity out to 2033.
Yeah, that was a smart move, especially in a higher interest rate environment. Locking that in was opportunistic. They significantly extended their debt maturity profile, pushed out any near-term maturity walls. That secures long-term financial stability. And their leverage ratio looks very manageable. It was sitting at 2.29 times debt to EBITDA at the end of Q2 2025. That gives them plenty of dry powder for whatever comes next. Future strategic growth, maybe even larger acquisitions down the road.
Okay, but with complexity and growth, there are always risks. We've touched on the external ones, like commodity prices. But what are the key internal or operational risk factors that, someone looking at this needs to consider?
Well, the primary one, as we've noted, is that inherent cyclical exposure. We dissected SKSS's vulnerability to commodity prices. But we also have to remember that demand for the more labor-intensive industrial services side, that is correlated with economic cycles. If the economy really slows down sharply, customers might decide to defer some discretionary maintenance, maybe postpone large industrial cleaning projects, even if the core waste disposal has to continue. The resilience, though, the buffer, comes from the fact that the non-discretionary core hazardous waste disposal business helps smooth out that volatility. Like you said, a manufacturer might put off cleaning their facility, but they absolutely cannot legally delay the mandatory disposal of hazardous chemical byproducts under RCRA. The regulations force that demand.
Okay. Then there's the intrinsic risk, right? The
Mhm.
operational and environmental liability. Just by definition, handling hazardous materials carries this constant possibility of accidents. Spills, regulatory breaches. A major incident could lead to massive fines, maybe even a regulatory shutdown, certainly long-term legal liabilities that could seriously damage their reputation, their license to operate.
For sure. And management mitigates this through an almost obsessive focus on safety, because their safety record is essentially their competitive currency with customers and regulators. They track performance using metrics like the total recordable incident rate, TRR. It's a critical safety measure in industrial settings, and they achieved a record low TRR of 0.61 back in 2024, which demonstrates that safety and compliance aren't just talk. They are a core operational priority, absolutely essential for maintaining trust.
And finally, there's the critical internal challenge, just execution risk. The company's whole growth story hinges on successfully integrating these big, complex deals, Hydrochem PSC, HEPACO, and also ensuring the timely ramp-up of those high-value internal projects like the Kimball incinerator. If they stumble badly on integration or face major delays in realizing the commercial potential of, say, the total PFAS solution, that poses a primary internal risk to the whole growth narrative investors are buying into.
It's the classic situation, isn't it? The bigger the opportunity, the greater the execution risk involved. No way around that.
So putting this all together, what does it mean when we look at Clean Harbors through the lens of the broader waste management sector? We kind of have to compare CLH to the big guys, the large cap titans, Waste Management, WM, and Republic Services, RSG.
Yeah, that benchmarking is necessary, but the context is absolutely everything here. WM and RSG, they're giants, yes, but they're focused mostly on municipal solid waste. MSW, residential trash collection, recycling, traditional landfills. Clean Harbors is the niche specialist. They deal with the higher margin, highly complex, hazardous, and specialized industrial waste streams. It's a different game.
And the size difference is just enormous. CLH is currently valued around, $12.5 billion? Compare that to WM and RSG, they're comfortably over $70 billion market cap. And CLH also has a lower consolidated adjusted EBITDA margin, hovering around 19%. Whereas the MSW giants, they routinely post margins up in the high 20s, even low 30% range.
Right, but that lower consolidated margin for CLH, it's really a feature, not a bug, of their specific business mix. While their core ES segment boasts those strong margins, above 25%, the inclusion of the lower margin, labor-intensive industrial cleaning services, plus the commodity-exposed SKSS segment, that naturally dilutes the overall consolidated figure, especially when you compare it to these super efficient, asset-heavy MSW collection model. Now, turning to valuation metrics, it's interesting. All three companies trade at pretty elevated expectations on a trailing price-to-earnings basis. They're all tightly grouped around 32 to 33 times trailing earnings. So high growth expectations seem priced into the whole sector.
But as you often say, for these kinds of capital-intensive infrastructure companies, maybe enterprise value to EBITDA is the more appropriate metric. It kind of normalizes for different debt levels and neutralizes non-cash charges like depreciation.
I think so, yeah. And here's where you see the divergence, the thing that really frames the current investment debate. Clean Harbors trades at a notable discount on this key metric. It sits at approximately 13.8 times EV/EBITDA. Compare that to WM and RSG. They consistently trade at significantly higher multiples, generally somewhere between 16.0 times and 16.3 times EV/EBITDA.
Okay, so why? Why does a company with what seems like an arguably superior, maybe irreplaceable asset network, stronger secular tailwinds in these high-growth niches like PFAS, and confirmed pricing power, why does it trade at a discount to the less specialized municipal waste players?
Well, we have to assume the market is applying some kind of penalty, probably for a few distinct reasons. First, yeah, the cyclical volatility, the part introduced by the SKSS segment and maybe some of the industrial cleaning exposure, that likely weighs on the multiple because investors just love the bulletproof predictability you get from long-term MSW contracts. Second, the market might just be taking a wait-and-see approach right now. They want to see the proof. They want to see the complete successful integration of HEPACO. They want to see Kimball reach full capacity and deliver on earnings. And they want to see more concrete evidence of that multi-billion-dollar PFAS revenue potential actually materializing before they fully price it all in.
Which brings us right back to that central debate we started with. Is the market currently underestimating the sheer scale, the duration, maybe the margin profile of that PFAS remediation opportunity? And is it failing to fully appreciate the sustained structural pricing power that CLH gets from basically controlling so much of North America's hazardous waste incineration capacity?
Or looking at the other side, are the current visible growth drivers, Kimball coming online, the HEPACO contribution, the initial PFAS revenue, are those things already fully baked into that high valuation, that 27.6 times forward PE? Does that leave very little margin for error if execution stumbles, or if the SKSS segment continues to be a drag on overall growth? That's the fundamental choice, I think, facing the disciplined learner looking at this company today.
Okay, so to quickly summarize the key takeaways from this deep dive, we've analyzed a really structurally powerful company defined by that two-segment dynamic. You've got the highly resilient, high-margin ES core engine, which gets strategically fed leads by the wide customer network of the more cyclical SKSS segment. The competitive moat here seems very tangible, very deep, built on those massive regulatory barriers and the permitting walls, significant capital needs, and those genuinely hard-to-replicate assets. And that foundation seems to guarantee continued structural pricing power in its core disposal markets. And the future growth path looks like it's driven by two major, pretty quantifiable catalysts. There's the immediate, highly visible ramp-up of the Kimball incinerator, which addresses current capacity shortages. And then there's the truly immense, long-duration, potentially very high-margin PFAS remediation market, where Clean Harbors appears to have secured a critical, scientifically validated head start.
And the resilience underpinning this whole model, just remember, stems fundamentally from that ratchet effect we discussed. Environmental compliance just isn't discretionary. During an economic slowdown, sure, a company might delay buying new equipment, maybe put off non-essential maintenance, but they absolutely cannot legally stop properly disposing of the hazardous waste they generate. The regulations force the demand, almost irrespective of the economic cycle for that core business. So here's the final provocative thought for you, the listener, to really mull over. If over 60% of all the commercial capacity in North America for the high-temperature destruction of the world's most difficult chemicals, things like PFAS, is concentrated within this one strategically protected network owned by Clean Harbors, how high does the ultimate economic value and the regulatory value of that unique capacity rise? Especially as regulations inevitably get tighter and the sheer growing volume of these forever chemicals needing guaranteed destruction continues to climb year after year. What's the ceiling on that value?